So Brisbane's been on a tear for more than 5 years now. Between population growth, further migration up north, and Olympics infrastructure spend, the story pretty much writes itself. But here's the question I keep asking. If you're entering at this point in the market, are you too late to the party, or are you entering just before the next growth phase kicks off? Because buying in Brisbane heading into 2026, it isn't a quick gain strategy. It's a conviction bet that the city will continue to outperform Australia's long run trend of between 5 to 6% growth for many years to come. So where do you find value now that the easy gains are gone? Well, that's exactly what I'm going to unpack for you in today's video. My top 5 suburbs for Brisbane in 2026, why each of those made the list, and what I'd be looking out for before entering into any of these markets today. And you'll want to stay right until the very end of the video, because with the 5th one, it's a blue chip suburb on the surface, but it has a catch that most individuals are simply going to miss. Guys, my name's Josh, I'm from Data Edge Property, and I help everyday Australians navigate the Australian property market using data. Data that's accessible to absolutely everyone. And if you get value out of today's video, make sure you hit that like button and subscribe so you can continue to see data-driven content just like this. And with that said, let's jump straight into it. But before we jump into the suburbs themselves, I want to touch on a theme that ties all of them together. And honestly, it's what started to make me a little bit cautious on Brisbane at this stage of the cycle. You see, yields across the city have gotten into the low 3%, and some pockets are even lower than that. And at the same time, a lot of these suburbs have delivered growth rates over the last 10 years that have far exceeded the national average. And that combination of low yields and high 10-year growth rates usually tells me one thing: you're not buying early in the cycle anymore. And remember, no market in the country ever outperforms the national average forever. Over the long run, performance tends to revert back to the national mean. And if you're getting into Brisbane's market at this point in the cycle, you're effectively betting on the city to continue outperforming for another decade. And then you've got affordability. And this next chart, it's the first real sign that Brisbane is cooling beneath the surface. Right now, ANZ's most recent affordability report shows us that around 52% of household income is required to service a new mortgage in Brisbane. And that's one of the highest readings we've seen in 2 decades. So whilst I still think that Brisbane will do fine long term, you have to go in with your eyes wide open. You're buying into a market that's more expensive, lower yielding, and already proven its point over the last 10 years. And that's exactly why the suburbs that I've chosen today, they're not about chasing growth. They're about protecting your downside while keeping exposure to genuine long-term demand. So with the macro out of the way, let's jump into the first suburb, and we'll start in Brisbane's southeast, in a suburb that perfectly captures what makes this city tick. So when people talk about accessibility in Brisbane, they're usually talking about this suburb. The first suburb is 8 Mile Plains. It sits right where the Gateway and M1 intersect, 20 minutes to the CBD, 20 minutes to the airport, and 5 to major job hubs like Upper Mount Gravatt and the Technology Park. It's one of those suburbs that's fully mature. The streets are established, its schools are rock solid, and there's barely a parcel of underdeveloped land left. And that built out nature, it creates stability because you're not competing with future land releases just down the road. So with that said, what are the key data points in 8 Mile Plains? Well, we're looking at a median price of $1.53 million, so it's definitely not your more affordable markets. A yield that is pretty weak, to be honest, at 2.6%, but that's pretty consistent across most of Brisbane right now. You're just not getting the 4-5% yields that we were getting 4 to 5 years ago. Those days are long gone. Vacancy rates are super tight at just 1%, and that's going to place upwards pressure on rents across the short to medium term. Days on market sitting at 37 days, which is not a hot market, but I'd say it's a pretty warm market at this point in the cycle. I do like the renter proportion at just 35%, which means the majority of individuals who live in this suburb are owner occupiers. And although that might not be a factor right now with vacancy rates at 1%, we all know that good things come to an end, and eventually that vacancy rate will begin to creep up. And the last thing you want is a suburb that has a huge concentration of investors, because that's natural competition for you when you go out to lease into the market. Stock on market, very tight at 1.2%, so there's pretty much no listings available in 8 Mile Plains. But one thing that I don't like is its 10-year growth rate. It's already exceeded the national average in a material way at 9.5%. So why is this suburb on the list? Well, the data screams balance. It's still got a super tight vacancy rate. It's a safe, steady corridor for owner occupiers and upgraders who want connectivity without that inner city pricing. Things to watch out for, however, is definitely affordability. Entry prices are already deep into the 7 figures, and with rates where they are, some segments could definitely flatten out. So with 8 Mile Plains, I definitely think of it more as a capital preservation play, not a speculative growth one. But if you drive 10 minutes south, you'll find a suburb that's cheaper, higher yielding, and still has room left to move. And that suburb is Callum Vale. Callum Vale often sits in 8 Mile Plains' shadow, but that's where the opportunity lies. It's a family suburb through and through. Parks, good schools, and strong community infrastructure. Typical homes in Callum Vale sit around the $1.3 million mark. Yields are a touch higher at 3.1% compared to its northern neighbor, and vacancies are sitting around 1.5%, which is still relatively tight. But why do I like it? It's because Callum Vale gives you most of the amenity that you'd find in 8 Mile Plains, but you get it at a discount. It's what I call a value shadow suburb. Similar demographics, similar fundamentals, but priced less for less hype. And the area's fully established too. There's no greenfield oversupply risk, so you get steady rental demand and decent liquidity when you do want to sell. Again, it's a relatively warm market with days on market at just 35. Stock on market, again, there's pretty much none at just 1.22%. And its 10-year growth rate is slightly smaller than 8 Mile Plains at 8.2%, but still ahead of that national average. What do you need to watch out for? Well, parts of Callum Vale still carry 90s and early 2000s housing stock. A simple cosmetic refresh can certainly add real value, but you need to pick streets really carefully. Avoid busy arterial roads and dated layouts. Now that's the south out of the way. Let's jump north, where a pair of suburbs prove to us that sometimes the quiet markets can actually be the most resilient. But before we jump into the third suburb, I'm curious to know from you guys, if you had $1 million to deploy today, would you spend it in Brisbane, or would you rather be investing in another capital city? Let me know in the comment section down below. I really want to know how you guys are reading this cycle. And the data tells me that over 90% of you who watch my videos are not subscribed. So if you don't want to miss out on future data-driven content just like this, make sure you subscribe to the channel. And with that said, let's jump into the third suburb, which is Chermside West. It's a suburb that doesn't get many headlines, but that's its strength. Whilst most people think of Chermside as apartments and traffic, the west side is completely different. You've got leafy streets, bigger blocks, and owner-occupied dominance. The renter proportion in this suburb is just 22%. Vacancy rates hover at just 0.5%, which is incredibly tight, and there's almost no land left to develop. It's got a median value of 1.18. Its yield, again, pretty low, which is consistent for Brisbane now at just 2.7%. So that's definitely something to keep an eye out for if you are a yield-sensitive investor. Now, why is it on the list, you might ask? Well, it's the classic example of defensive growth. It's a market that really hasn't had that boom and bust in it. It's really just grinded steadily over time. And that's certainly attractive for investors that have a more long-term horizon. I also love the proximity to Prince Charles Hospital and the Westfield Employment Hub, two anchors that keep the tenant pool super strong. What would I be keeping an eye out for now? Well, it's price compression relative to its neighboring suburb, McDowell. When the gap between the two gets too wide, you tend to see buyers begin to swap sides. And speaking of McDowell, that's where the next story gets super interesting. McDowell is the fourth suburb and it sits right next to Chermside West, but the buyer profile is slightly different. You see, it's a step-up location. Families moving from Everton Park or Stratford Heights who want bigger blocks and better schools without paying that Ashgrove premium. Limited land in the suburb means that new supply is pretty much non-existent, and that keeps the market super tight. McDowell has a median value of $1.18 million. Its yield is pretty consistent with Chermside West at 2.7%. Vacancy rates are incredibly tight at 0.6%, and you can see that the days on market is actually getting pretty hot right now at 25 days. I love the renter proportion in this suburb at just 20%. Again, it's a super owner-occupier dominated market, which I love for all of the reasons that I mentioned earlier. There's virtually no stock on market at 0.74%, but again, and this is consistent with Brisbane, that long-term growth rate does begin to concern me when it exceeds the national average in such a material way at 9.2%. But why do I like it? Well, McDowell is a classic steady compounder. It might not deliver double-digit spikes, but its risk-adjusted returns look fantastic over the last decade. Its super low vacancy rates tell you everything that you need to know about demand. You also get super strong community feel there. Lots of locals who move within the suburb that stay there as opposed to leave straight away. What would I be looking out for in McDowell? Well, again, just be super conscious of that 10-year growth rate. The fact that it has performed so strongly in the last 10 years indicates to me that we're pretty late in the cycle now. And if you're getting in now, you are betting that this market is going to continue to outperform the national average across the next few years. Now, if you want to see the exact framework that I use to filter out bad assets, make sure you grab my completely free property due diligence checklist in the description box down below. It shows you exactly how to spot red flags and other problems before you buy. And if you think that Brisbane's had a good run, wait till you see what's unfolding in Melbourne and Perth. I've put together a breakdown on that exact topic. It's on screen now and in the description box down below, so make sure you check that out right after this one. You will learn exactly why I'm watching those two cities much more closely in 2026. With that said, let's jump into the very last suburb, which is Kenmore. You see, Kenmore is the type of suburb that rarely makes investors' lists, and that's why I love it. It's a true owner-occupier suburb in Brisbane's west. It's got great schools, strong community, and just enough amenity to keep people there for decades. You're about 10 minutes from the CBD, near Indooroopilly and the river corridor, and there's almost no developable land nearby. You're looking at a median value of $1.29 million, a yield of 2.8%, vacancy rates of 1.8%, a 10-year growth rate, which is a little bit lower at 7.2%, so closer to that national average. Days on market, little bit higher at 39 days, but definitely still a warmish market. I love the renter proportion in Kenmore. It's just at 17%. So this is owner-occupied gold. And lastly, stock on market is super tight at just 1.36%, which is consistent with all the other suburbs that I've spoken about today. So why is Kenmore on the list? Well, the answer is scarcity, because that's what underpins long-term capital growth. Even as other areas begin to soften, owner-occupier pockets like Kenmore tend to hold firm because people don't sell unless they absolutely have to. What would I keep an eye out for though if I'm looking at Kenmore? Well, be aware of the micro flood risk around Moggill Creek. Most of the suburb is fine, but always check the overlay maps street by street. Also, entry prices are relatively high, so focus on renovation potential to be able to manufacture that capital growth in the future rather than expecting outsized growth on autopilot. So with that all said, Brisbane's story is still strong, but this next phase, it isn't about blind momentum. It's about selectivity. You want suburbs with genuine scarcity, steady family demand, and minimal flood or land supply risk. Because in a market like this, it's not about finding the cheapest suburb. It's about finding the smartest one that's backed by the data. And if you've made it this far, you're part of the data-driven 1%. The investors who think before they act. You're not chasing noise, you're building conviction, and that understanding, it's your edge. Guys, I seriously appreciate you sticking around right till the very end of the video. If you got value out of it, make sure you drop a comment in the section below, hit the like button, and subscribe so you continue to see data-driven insights just like this. And as always, I'll catch you in the next one.